Good morning. Today is Thursday, August 10th. My name is Adam Kahn, and I'm the Rational Investor. Hope this all finds you well, and I hope you're having a good day. Excuse me. Today, CPI came out. It came out a little better than expectations, and just a little bit, but hopefully it still means I'm hoping the Fed is pretty much done. From my perspective, for those of you who don't know me, I do mortgages for a living, and we've slowed plenty. It's not selfish reasons. It's not that I hope to be busier. Quite honestly, in the long run, the slower we are for the longer we are, more people will leave the business. Eventually, the market will normalize. So it really makes no difference to me. I'd end up better off if it stayed slower for longer in the long run. But it's really more that I think they've slowed it enough, and I don't know that they always see those effects. But that being said, from what the Fed fund rates are showing, looks like odds are the Fed will more than likely pause next meeting, and they even lowered the expectations for November too, dropped down to like 20 or 25% for November as well. So I want to talk to you about the thing I've been focusing on lately, which is like how to become rich. And I'll stick with equities and stocks, and I'll go over the list that I keep of the top 20 or 25 stocks that that I think are the best companies there are. And the way I look at investing now, please don't follow me. I'm just some idiot on YouTube. Like, really, I mean that seriously. I've made enough mistakes over the years. I'd hate for somebody to follow my advice, take it like I gave it as the gospel, and said it was my fault or did something like that. You need to make your own decisions. You can't look to somebody else to help on these things. But I don't think getting rich quick, as much as we'd all love to do that, is a realistic scenario. And I think you own good quality things that go up in value, whether that's stocks, whether that's real estate, whether that's collectibles or wine or whatever it is that you're into that you like. If you know a market and you think it's going to go up at a faster rate than something else, there's no reason I would think you're wrong. I just may not follow that market. Me, I like stock market in terms of that. Partially, I like real estate, but when I own a stock, I don't have to worry about the air conditioner breaking. I don't have to worry about my tenant leaving. I don't it's just I don't have to worry about any of that. I own the stock and they run the company, and hopefully that stock goes up in value over the time. And I hope if I own really good companies, they do better than the rest of the market. I don't really want to own EFTs. I don't want to buy mutual funds for the most part. I want to stick with the companies I like. Now, I do like to trade, but when I talk about my trades, please understand, if I'm worth $20,000, whatever that number is, I'm only using like 1%, 2% in my trading account just because it's fun, not because I'm hoping to make a living at it. When I was a trader, for my living, it was so much different. I was on the floor of the exchange. There's much bigger advantages and different things going on. The markets were wider, they were less competitive, it moved around more. It was just a different scenario than what things have changed to today. I think it's really tough to make money trading at this point. I'm sure there are people that are successful at it, and kudos to them. But for me, it's more out of fun because I've lost success at a lot of that. I generally just spin my wheels, but I enjoy the ups and downs, and it's hard for me to not trade just based on my personality. You know, what kind of prompted me wanting to chat again today about similar stuff was a conversation yesterday I had with a buddy of mine. His name's Steve, and he made a comment to me. He always jokes around because he loves to trade. He's like, man, if whatever stock we're talking about gets to some really high price and you don't sell it, I'm coming over there and I'm strangling you. We laugh and talk about it. But so we talked about Amazon a bit, and I told him I think I sold, you know, well, I'll tell you what I did, and then I'll tell you how I'm set up. So I think I sold a January 200 call, no, I was looking at a January 200 call recently, and I kind of said to him, I don't really sell calls like that in Amazon because the volatility's so low. If I'm guessing off the top of my head, a January 200 call is probably only, 60 cents, 70 cents, 50 cents, somewhere in that range. And the reality is, it's not worth the 50 cents for 6 months or 5 months to me for getting taken on a stock that I just want to own. And that was where he gave as usual. But if Amazon gets to 200, I'm going to strangle you. I said, but here's the problem, Steve. In a company like Amazon, if it's gone from 140 to 200, odds are they're making more money. They're all cylinders are on go. Things are going well. Why do I want to get out of that company? It's not about the price, it's about the fact that I still own a great company. I understand, like, from his perspective, it's gone from 140 to 200, but that doesn't mean it's going back to 140. And I don't want to lose my position because if they're doing all the right things and it's gone up in that amount of time, maybe it keeps continuing, and I sure don't want to lose my stock. Now, what I do in terms of my actual trading, I have two different accounts that I have. Most of my money gets put in an account where they don't even allow online trading. If I look up quotes, they're like 15 or 30 minutes delayed. It just shows my positions. And out of wanting to look, I look, but the reality is I shouldn't even look at that account. Then I have a completely separate account with way less of my funds that I'll trade. So in the example of Amazon, I did let him know, when earnings came out and the stock went up a good bit, I sold short dated 150 calls against that position. Why? Because short term, maybe a stock has ups and downs, and if I get taken on that stock, it is an account I trade. Maybe the stock goes back down and I get back into it. Maybe I just move on to a different stock, but whatever it is, it's a different type of account. And for the most part, I don't really want to pay attention, but I do have an account where I play around a bit. But I also don't look out to January calls because I'm looking at stuff a week out, 2 weeks, in terms of getting just some variation in price fluctuations because things, move up and down, and the traders try to squeeze out stops or whatever else. That maybe it goes up, it comes down, it goes up, it comes down. And then I don't mind trying to trade that. Maybe it's a good trade, maybe it's not a good trade. Not super concerned about those. Same. I like to do that a little with Tesla, but I have a little Nvidia. Geez, if it goes up again like it did last quarter, I just don't want to get taken just like the other. Like, what if they have that AI chip for the next 2 or 3 years and just outperform for the next 2 or 3 years? I mean, they could be today's version of Tesla from years ago that just goes and goes and goes. So let me talk about the stocks I really like. Again, don't follow me, you pick your own. So this is my list, but it's in no particular order. It's not like I have more of this one or that one and I put it in the order that I just like these companies. And if you have companies you want to ask about, just ask. Odds are, if it's a big company I've heard of, I'll agree. It should be on your list, and it's a great company. It's not a matter that mine are right. My thought is just stick with big, top name companies. So I have Amazon, Google, Meta, Starbucks, Tesla, Archer Daniel Midlands, Caterpillar. I thought I said Exxon. I might have missed one, but Exxon, Chevron, AbbVie, Bristol Myers, Disney, Apple, Nextera Energy. I have an asterisk next to it. I have Match.com on there because I think they're top in their field. And, my brother made a comment. They feel like a real volatile tech stock, but they have real earnings. And even though they're uncomfortable to me because I didn't grow up in a generation where we had that stuff, I think my nephews and nieces and my son's a little young, but I think they all use it, and I think as life continues, they'll continue to use that stuff. Um, and I think everybody uses that. Like, I think that's where you go for dating at this point. And the reality is, if it was around in my day, I would have loved it. I hate going to bars and stuff like that to meet people when I was a kid. It would have been so much more comfortable to go online, chat with somebody a few times, see if we get along, and maybe meet up and go to dinner or go to a movie or something. And I think that's kind of how it works, and maybe I'm wrong about it. But either way, I kind of like the company because, again, I think they're top in their field, and I think they'll continue to grow since it gets used so widely. I'd say McDonald's, I'd say Target or Walmart, maybe Dow Chemical. There's a whole bunch out there. And, and if I were looking to start a portfolio, I wouldn't try to look to pick the bottom or where a company's cheap or even those companies. Meta's run from $80 and change a share all the way up to over 300. It's still on my list. And back to the conversation with Steve, I wouldn't wait for it to drop to 250 or whatever. I wouldn't even worry about it. It's one of the top companies. I just want to own the top companies. And I think that the funds and everybody else keeps prices pretty relatively fair for today's value. Maybe it goes lower, maybe it goes higher. But I wouldn't want to wait for 250 or 280 or whatever number I think Meta is falling to, if I don't own it already, to get in, because if it never gets there, I never end up owning a stock I think is a great stock. I just want to own the great stocks and hope that they outperform the market continually. I don't think I want to be hyper focused into only three or four. I think there's a little bit more risk than that. But I think if you have anywhere from 8 to 30 stocks, probably well spread out. The other thing I don't do, because I know a lot of them talk about this, if I have more than 5% in one stock, it probably didn't start that way. And it doesn't mean I get out to lower my percentage of that stock. Because if I owned, and I did not, this is just an example. If I bought Tesla way back when, and it's had the run it's had, I don't want to be getting out all along the way and miss that run because I have too big a percentage of my portfolio. If one stock runs, it runs, and that's just the one that outperforms. If I became so top heavy that 20, 30, 40% of my account is one stock, sure, I'd probably lighten up. But outside of that, I hope to own that stock that just outperforms like that and stick with it. If I still love the company and it continues to grow, I don't want to get out. Like that's just a general philosophy. So, Meta, for example, that's run from the 80s to 300, well, maybe it's larger than 5% in somebody's account. Still Meta, still makes a lot of money, still does this well. It goes from 300 to 1,000, same thing. And if it goes from 1,000 to 2,000, same. Now, if it gets at 1,000 or 2,000 or whatever, and you kind of look down, it's 25% of your portfolio. Sure, maybe drop it back down, but I'd probably still say heavy in it. I'd probably still be at 15% of my account, even though that doesn't make, that might be a little too much. Reason being, when I bought it, it was only 4, 5, 3, percent of the account, and it's just running well and moving on all cylinders. I don't want to lose those companies. I just want to stick with the best of the best. Anyway, thanks for watching. I hope you guys enjoy the content. I'd love, feel free to chime in and chat. I'm happy to talk about what I do at work. I'm happy to talk about stocks, bonds, any markets. I like metals. I like baseball cards. Feel free to do a shout out and ask me what you think. Have a great day. Bye bye.